Hello everybody, this is an important video. I'm making this video for myself, but the knowledge is too good not to share. Bookmark this video and come back in 6 months, 12 months time, because this is the video that tells a lot. I'm sick and tired of listening to analysts talking about how when the pivot happens, that's when the bear market comes, or, the interest rates are just going to be hiked so many more times. Of course, the bear market's going to continue, or other flawed logic. Even Benjamin Cohen speaks about like the average time until about bear market bottom. But they all contradict each other. And so there's nothing that I can really take their word for unless I go and look at the data for myself. And this is remarkable. What I have found here, I've spent considerable time, and I'm just going to talk you through this. This is the single view we're looking at here. And what you can see here is the S&P 500 monthly view over time, dating all the way back to the mid 70s up to present day. And overlaying that is the US interest rate index. So on this left-hand scale here, you can see the interest rate, and on the right-hand side, you can see the scale for the S&P 500. Now, watch as I show you history, and then you tell me what you think is going to happen as we get to here. So here we go. 1st of November, 1976. That is the bottom here. All the way through to the 1st of March 1980, the Fed raises interest rates by 15.25%. That is the most violent wave of rate hikes in history, and yet the S&P 500 rallied a net 17.87% throughout this period of time, from here to here. All right, I won't, trust me, it's 17.87% net. So then at the pause, it then tanked here about 21% to finish a net 3% lower overall. Not exactly a bear market. Okay. The next one, 1st of June 1980 to the 1st of May 1981. The S&P rallied another 17%. All the while, the Fed raised interest rates by 10.5%. That's the second most violent interest rate hike of all time, 10.5%. And yet the S&P market goes up 17%. It tops out at this double peak area, right? And then it gave it all back over the next 15-month long pivot to finish again, a net 3% lower than where it started. Again, even then, not a bear market. 3% lower than where it started is not a bear market. Okay, so that's a crazy time. But even in the most crazy time, you were what, 3% down? Like, big deal. I mean, sure, you were flat, pretty pissed off. You've basically wasted, let me see, you would have wasted really 76, 78, 7, 78, 79, 80, 81, 82. Like, in 6 years, you basically made 20%. All right. So if you wanted to look at it that way, even then, you're still better off, but it's not great. It's not great. Most people want to double their money almost in that time. Anyway, moving on. The point is, it was not a bear market. The next one, 1st of December 1982, which is here. 1st of December 1982 to the 1st of August 84, the S&P rallied another 17%. Funny that. Putting in new all-time highs throughout the tightening cycle, and then throughout the pause and the pivot, it continued to rally another 38%, creeping up, putting in all-time highs. Why? So that was a net increase of 3.25% on the interest rate. Then in August 1986 to February 1989, the Fed raised interest rates by a net 3.87 points, and the S&P just rallied again. Another net 29% rally, new all-time highs throughout the interest rate tightening, even accounting for this temporary violent correction to down of 32%, it continued to put in all-time highs throughout the pause, throughout the pivot, corrected 20% mid-pivot, but did a swift V-shaped recovery and continued to rally another 38% throughout the QE. Wow. Where's the bear market, guys? Okay. Then we have the 1st of September 1992. That's around here. Through to 1st of February 1995. Okay. That's just here. It's a nice little 3% increase. 3 basis points. 3 whole basis points. The S&P had no bear market again. It rallied 13.7% to a new all-time high. There was short, gentle pause of several months here, and then a gradual pivot, which is really quite restrained. And during this time, the S&P temporarily corrected about 9.5% and then soared another 243% to new all-time highs, even throughout more rate increases. It wasn't until the market started to falter here at the peak, second peak, and then break bull market. It broke bull markets. Look here, it's important to note what happens first. The market broke bull market support. And then in response to that, the Fed reduced interest rates and went into QE. It's not the other way around. The Fed didn't cause that one. The dot-com crash did. Okay. Now, 1998. 1998. Oh, we just did that one. Sorry. 2003. June 2003. Where are we? There we are. June 2003 to June 2006. This was a plus 4.25 basis point interest rate hike. The S&P once again, look, no bear market, just rallied 36% to new all-time highs. Then it continued to rally another 23% during the pause. And then 5 months after the Fed decided to lower rates, 5 months after, then the S&P broke bull market structure and began to tank. So in this case, the Fed pivoting did start to cause, or we don't actually know what the fundamentals are, but whatever the reasons for the Fed pivoting and dropping interest rates, that actually coincided with causing the markets to tank. Okay. And that brings us to 1st of October 2015 to 1st of December 2018. Now this one, 2.25% interest rate hike total, not that big. The S&P bottomed in the first quarter, right at the beginning, as you can see there, of gradual rate hikes in February 16. And then it rallied a net 25% to new all-time highs throughout, even after accounting for any other violent corrections it would have had around here. 25%. During the pause and even after the pivot, the S&P continued to rally another 37%. It was only brought down by, you guessed it, COVID. And that brings us to today. So here, this time, we have a 5% net increase so far. That's what they're expecting it to be by June. 5% net increase, going from 0.25 to 5.25. 1st of April 2020 to 1st of June 2022, the S&P tops out at the announcement of the rate hikes this time and tanks 25% before swiftly recovering to present day, where it currently sits at present day, which is just 14.5% down from the all-time highs. That doesn't even qualify as a bear market anymore. 14.5% down from the all-time highs is actually a correction. So if this continues to rally and recover, which I would expect it to throughout any more rate hikes and throughout the pause, I would expect this thing to keep going and put in new all-time highs. And then potentially then we crash. Think about it.